Great wealth demands great wisdom. Great power demands great care. This is Principles of Benevolence. I'm Ebony Brown, and after a decade in venture capital, I've seen firsthand how capital shapes society. Each episode, I sit down with founders, investors, and leaders that prove that purpose and profit aren't enemies, they're partners. So let's explore how to build companies that matter, invest with intention, and lead with benevolence at the core. Today's guest has spent nearly 5 decades proving that you don't have to choose between making money and making a difference. Dr. Freada Kapor Klein is the founding partner of Kapor Capital, which invests in seed-stage tech startups that close equity gaps. And her portfolio doesn't just create positive social outcomes, it delivers top quartile financial returns. In 2025, she was honored by Forbes 50 over 50 for her investing work. But Freada's commitment to equity didn't start after she built wealth. It started at the very beginning. In 1976, she co-founded the Alliance Against Sexual Coercion, the first organization in the U.S. to address sexual harassment. She was a founding team member of the Hollywood Commission, chaired by Anita Hill. And 25 years ago, she launched SMASH, which provides rigorous STEM education and access and social capital for low-income high school students of color. She serves on the national board of the NAACP, where she helped to launch NAACP Capital, a $200 million fund of funds. And she and her husband, Mitch Kapor, co-authored Closing the Equity Gap, which lays out exactly how to create wealth while addressing the inequalities in startup investing. Today, we're diving into her recent Chronicles of Philanthropy article that challenges one of the biggest myths in investing, that impact means sacrificing returns. For anyone managing capital, whether you're a foundation CIO, family office allocator, or aspiring investor, this conversation will give you a roadmap for deploying capital that does well and does good. Let's welcome in Dr. Freada Kapor Klein. Freada, thank you so much for being my first guest on Principles of Benevolence. I'm really excited to dig into your Chronicles of Philanthropy article that you wrote recently, and also just everything that's gone into your history and starting Kapor Capital and just your career of activism and supporting others.
Well, thank you. I'm honored to be your first guest. It's a pleasure to be here.
So you've dedicated your career to activism and closing equity gaps. Was there a specific moment early in your life that crystallized you wanting to help others?
Well, yes. Being an activist and working so that everyone is treated fairly has been the only thing I've ever been interested in, and the only thing that has really propelled me through each of my career choices. So early on, I came to the belief early as a little kid that none of us are free until all of us are free. And that had to do somewhat with being raised culturally Jewish more than religiously Jewish. But of course, I have family members, including aunts and uncles, who were murdered in pogroms in Russia for being Jews before my grandparents managed to get here and had my mother. And so that family legacy, but also just watching what was going on in the country as a kid, was very unsettling to me. I grew up in the 50s and 60s watching the major movements of our time, the civil rights movement in the 60s, the anti-war movement in the 60s and 70s, the third wave of feminism in the 60s and 70s. All of those movements had an impact on me.
Yeah, you've definitely been on the journey of fighting for others long before even what you've built today with Kapor Capital and the Kapor Foundation and SMASH. How did what you did before with activism and sexual harassment prevention in the workplace, how did that kind of help inform and shape the early work that you did with building Kapor Capital?
Great question. They're sort of all threads that wove together. And what I kept doing through my activism is looking at how do you get closer and closer to the sources of power and decision making. And you can't change power structures without changing economic and wealth distribution. And so understanding that is what drove me to understand much more about economics, much more about investing. Um, and that then built on my long experience as an activist. You mentioned my work around sexual harassment. So I co-founded the first group on sexual harassment in the United States. That was 1976. That's before it was illegal. And what has been erased, and I use that term specifically, has been that the first cases of sexual harassment that made their way through the courts were all Black women plaintiffs. And the early history of sexual harassment was the interweaving of racism and sexism and the abuse of power against the most vulnerable, which was Black women, and in that case in the workplace, but not different than in other spheres. And so the early history of sexual harassment is the early history of Black women leading, fighting back.
Yeah, and I know that you were able to even show leadership and benevolence in the workplace by helping to change policies at Lotus
Mhm.
to make sure that it was a lot more progressive. And that was much before the conversation was even prevalent or that there were even words around
Uh-huh.
sexual harassment. And I feel like you were also, in a similar vein, a pioneer for investing in closing equity gaps. That also wasn't, it's common language for us now that there's starting to be some pushback against it again, but there's so many other people that have been able to um, follow in the trail that you've been blazing over the past few decades. So thank you for that.
Well, thank you for recognizing that. The work has been compelling and it's also been lonely at times.
I definitely understand that. So getting into your chronicles piece, and there's been a lot of talk about it. I feel like I'm not even, as tapped in. I've been hearing about it, which is good. So you
Great.
wrote that foundation chief executive officers and chief investments officers have historically worked side by side, but not truly together. Can you explain what the glass wall looks like in practice? Like, what is the disconnect inside of foundations? And how did you break that wall at Kapor when Allison Scott joined the investment committee?
Great questions. So, philanthropy has long abided by a principle that the job is to make as much money as possible so that you can give it to what you care about. And what we argue in our Chronicle of Philanthropy op ed that I wrote with my husband, Mitch Kapor, just got published. What we argue is if 95% of your funds, which is what's sitting in your endowment, is investing in companies and funds that widen gaps between haves and have-nots, that widen gaps across racial groups, across gender groups, across all kinds of gaps. If 95% is devoted to just making money, what we lovingly call greed-only investing, and then you take 5%, which is the legal mandate for a foundation, take 5% and give that away to 501c3 nonprofits. Who's going to win? 95, 5. That gap is just enormous. And so you're never going to combat the things that you say in your mission you're going to combat. This has a long history of thinking that the program side are the people who are mission focused and the investing side only care about making money. And that's the fundamental flaw. So what we did at Kapor foundation led by Dr. Allison Scott. She's been with us for more than a dozen years, but she's been in the CEO seat of the foundation for about half that time. She started as our director of research and then became the chief research officer. And we thought it was very important that she have a major voice in saying how the endowment got invested. She's the CEO of the foundation. So, and that is highly unusual. I was at a closed door, off the record meeting not long ago of major foundations, mostly New York based, but not entirely. And there were some CEOs and some CIOs in the room together. And what got expressed is that there is a bit of a fear of each other. So if the CEO says to the chief investment officer, I want you to invest consistent with mission, the CIO might say back to the CEO, okay, if I do that, it's going to lower my returns. You're going to have less money to give away, and you're going to get fired by the board. Right?
Yeah, for sure.
What the CIO doesn't say is that the overwhelming majority of CIOs, first of all, are paid more than CEOs, and their compensation is determined only by their financial returns. So if they believe that you cannot earn top returns by impact investing, then it's their self-interest they're arguing for, whether or not they admit it. So what we recommend is that the CIO compensation be determined by both impact metrics and financial returns. And that then aligns the CEO, the CIO, and everyone is aligned towards fulfilling the mission of that philanthropic institution. Foundations are sitting on trillions of dollars. In my opinion, it ought to be the most risk-taking capital, and yet it's often the most risk-averse capital. And why should it be the most risk-taking? It is not taxpayer money. It is money that is sitting there and was supposed to be given for the betterment of society. And with each foundation has its own specific mission. Is it education? Is it healthcare? Is it widening systems of justice? Is it changing the criminal justice system? Is it reducing climate change? So foundations have very specific missions, but all of those can have aligned investment criteria.
So you touched on this a little bit, but I want to address the elephant in the room. The question that I hear a lot is, how do I invest for impact? Like, will my returns suffer? Basically, the myth of concessionary returns. And the resistance does seem to be growing. Like, seems like there's almost a war on impact investing right now. Can you walk me through, like, why does this belief persist, especially when you've been able to prove with Kapor Capital? You have top 25% returns from that fund.
Mhm.
How do you actually go about constructing a portfolio that proves that gap closing investments can generate top quartile returns?
Well, you have to be disciplined and intentional, as you need to do with all investing. And so for each foundation, it starts with the foundation's mission. So, what would a mission that says we want to broaden access to education, or we want to improve math and reading scores, or in this age of AI, we want to make sure that responsible and ethical AI becomes front and center, not AI for the destruction of humanity. So, whatever your mission is, you need to align your investment criteria. And since I don't know of foundations that have a goal of making society worse, starting by aligning your investment principles with your mission ought to put you in the direction of looking for investments that are consistent. So I think part of where you start is a rigorous conversation with your board to be able to change your investment criteria. In the summer of 2024, Institutional Investor, the publication, wrote a story about 3 California foundations that had each of them with billion-dollar plus endowments had just made a commitment to investing their entire endowments consistent with mission. And one of those, California Wellness Foundation, the CIO, Rochelle Witharna, just recently wrote an op-ed about how the performance of underrepresented investment managers has been outstripping the performance of other managers, and how she is able to meet that impact goal and to return more money than her peers. So I think we need to look at the data and stop hanging on to outdated myths.
Yeah, I feel like people just kinda hang on to fear,
Mhm.
and especially right now in a time of uncertainty, people are just retreating to the things that they know and are scared to step out, but if we continue to share information and give them tactical steps and great examples like what you've built, then hopefully we can help people along on the journey.
Well, that's great. I hope so too.
And your Chronicle piece sparked a lot of conversation, including pushback.
Uh-huh.
There's a SSIR article arguing impact investing doesn't exist. It's just good investing with better marketing. For allocators that are trying to figure out how to deploy capital, does this terminology debate matter? Should they think about themselves as impact investors or just good investors who care about outcomes? What's the practical difference? I'm kind of trying to make this word benevolence work since
Uh-huh.
people are scared of DEI or impact investing or whatever else, but want to get your thoughts.
Well, I think a couple things. One is I think the term impact investing has come to mean anything and everything to everybody. And so while that's a big tent, it runs the risk of being meaningless or at least lacking rigor. And so I think it's really important that we pick rigorous criteria when we're talking about impact investing. I think there's been a tendency towards producing scorecards, trying to produce points for any kind of impact. And so what happens is you end up dumbing everything down. And as Mitch likes to say, if you have enough recycling waste baskets in a point system, it can overrun the fact that you don't pay anybody a living wage. So I think impact criteria need to be rigorous and they need to be tied to each foundation's mission. How you measure, and you know this from your great experience in ed tech, how you measure impact in ed tech is quite different than how you might measure impact in a fintech or in health tech or in gov tech. So I think you want to start with impact criteria that meet not only the foundation's mission, but that meet the specific goals of that investment vertical.
Yeah, I can say from like my experience across the portfolio, we would set individual metrics for each company, whether that's graduation rates or job placement, um, and being able to track that consistently every year
Uh-huh.
as a depth metrics, and then thinking about a breadth metrics across the portfolio, like number of learning served, if you want to see like what that big number across your portfolio look like. But it's always going to be a unique metric and not necessarily one size fit all for impact.
Exactly. Exactly.
So, a recent UBS Global Family Office report found that 27% of family offices are now pioneering an integrated approach, essentially moving away from siloed philanthropy and instead coordinating capital across the entire ecosystem. For a family office CIO or foundation leader listening who's inspired by your work but kind of feels stuck in the traditional siloed model, you talked about this a little bit, but wanted to know if you had any other strategies on how they can align their entire endowment with their mission.
Sure. And again, as I mentioned, I think a lot of this starts with a board conversation, and it needs to be led by whether it's the CEO or other program staff, or whether it's being led by the CIO. So you need to start with whoever the champion in the organization is, and you need to get all of your ducks in a row. You need to gather all of the data, whether it's Rochelle with Arna's recent op-ed, or whether it's our op-ed, whether it's case studies from business schools on impact investing. Get all of the data you can and make that available to your board and have an organized conversation. I was speaking with the CEO of a foundation that's got about $1 billion endowment, and she was asking me, how do I start? And so I spent a lot of time, I sent her a lot of articles, and then she was taking her entire board on a site visit to the legacy sites in Montgomery, Alabama, because part of what they work on is reducing racial disparities. And so she wanted her board to have a unifying and visceral experience and to understand the origins of racism in this society. So she took her entire board to Montgomery. She assigned them the book that Mitch and I wrote that came out in 2023, Closing the Equity Gap, that is case studies about Kapor Capital, portfolio companies, and our overall approach. And they are coming up with new investment criteria. Some foundations put a cap on how much they invest. One major New York foundation, multi-billion-dollar endowment, had a 10% cap on impact investing, reflecting the fact that they wanted to put a toe in the water, but that they didn't really believe that it was going to bring in competitive returns. Based on their experience with that 10%, they've now lifted the cap. So I think finding out what other peer institutions are doing and what their experience has been. There have been some leaders in the field. It's a number of years ago when Darren Walker, he's recently retired as head of Ford Foundation, but a number of years ago, they committed their first billion to impact investing, and they have a team responsible for it. So I think that there are organizations who have been trying this for some number of years. And I mentioned the 3 California foundations mentioned in the 2024 Institutional Investor article. So I think there's a growing body of data out there. One of the things I find interesting is that even traditional institutions like KKR
Mhm.
discovered that their impact fund performed just about the best of any of, I think it was 17 funds.
Wow.
So they were not making a commitment to impact, to move anything to impact because of consistency with mission. They're a big PE firm, but lo and behold, they discovered that impact did better than most of their funds. So again, I think we want to look far and wide and be rigorous about data.
For people that are less familiar with Kapor Capital and the Kapor Foundation, can you talk a little bit how you have aligned your strategy with closing equity gaps through investing in emerging managers or direct investments, just to give people some of the tools that you use?
Well, our focus, whether it is on the investing side, and as you mentioned, we do both direct investing and we do fund investing. So whether it's on investing, whether it's on grant making, whether it's on programs that we've started, this is the 25th year anniversary of SMASH.org, Summer Math and Science Honors. It's a nonprofit I started 25 years ago, which is a STEM access program for underrepresented high school students. And so whether it is the nonprofit, the foundation, the venture capital arm, the family office, we have a shared mission, as you said, of closing gaps of access or opportunity or outcome for low-income communities and or communities of color. And so the focus there is on the outcomes. What do the businesses that we invest in, either directly or through funds, what is the outcome of those businesses? If those businesses succeed, who is better off? So people often confuse us with saying, well, we're a DEI fund and we invest in diverse managers. We invest in businesses and funds whose outcomes lift low-income communities and communities of color. It happens that those outcomes correlate with underrepresented managers, but we don't stop at and we don't look just at the demographics of who's managing the fund or the demographics of the founder. Those don't tell us enough. There are plenty of gap-widening businesses that are started by women, by people of color. Those aren't businesses that we're interested in. We are interested in gap-closing businesses, regardless of who is starting them. But again, there's a strong correlation for businesses that, for instance, that uplift the Black community. Far more likely that those are started by a Black founder, but it's not a requirement.
Because they have the proximity to the problem.
Exactly. We talk about lived experience. In the Closing the Equity Gap, we talked about lived experience a lot, mattering for the fund manager and for the entrepreneur. You need to deeply understand the problem you're trying to solve, and often the motivation for coming up with your idea of how to solve that problem came from your lived experience. Starting and sustaining a business, starting and sustaining a fund require inordinate commitment and perseverance. And often it's that lived experience that powers one through the rocky times.
And what gives you hope that this shift from siloed philanthropy to integrated capital deployment is actually happening?
Well, as I mentioned, there are multi-billion-dollar foundations that have already made the commitment to investing consistent with mission or are exploring it. I think there are many factors contributing to that, including a generational shift, so that there are many younger folks taking over family foundations, folks with inherited wealth, and they want to invest differently. They don't want to just use the old traditional Wall Street firms that their parents or grandparents were using. They want more active involvement in how the money is invested. They want to monitor outcomes, not just returns.
Well, I'm hopeful that this change is happening, and thank you for, again, being a pioneer, but not only that, for always moving with such conviction, and not being shaken or rattled, as the landscape around us change. I think we need more of that.
Well, thank you so much. Very kind of you. And we need more fellow travelers and we need rigor. We need all of us to band together. We need to be honest about what's working and what's not working because we have a responsibility to move this field forward.
Totally agree. Thank you, Freada.
Thank you.
Thanks for listening to Principles of Benevolence. If you like the show, please subscribe, rate, and review on Apple or your favorite platform to listen to podcasts. And as an act of benevolence, share with an ambitious friend who wants to build a life with purpose in mind. You can find me at Principles of Benevolence on IG, LinkedIn, and YouTube, and principlesofbenevolence.com. Until next time.